Hey traders, most of you trade futures on your NinjaTrader platform, so today let's talk about who are the key participants in the futures market. First of all, just to recap, what exactly is a futures contract? Each contract that you go long or short on in your daily trading is actually a legal agreement on one of the futures market exchanges. Those exchanges are the NYMEX, the New York Mercantile Exchange, the CME, Chicago Merc, and the CBOT, the Chicago Board of Trade. Now, those contracts are actually regulated here in the U.S. by a commission, okay? That's the CFTC, the Commodity Futures Trading Commission, and that absolutely regulates the ability to purchase and sell the underlying instrument that that contract is written on. So as you can see, there are futures contracts to trade in or hedge just about every conceivable commodity in the futures market. Here is a list in our NinjaTrader. You easily can access this list of instruments. Just right-click, go to Instruments, go down to Search, and here is everything on the platform that you're associated with, whichever broker you're using. So up here we've got the T-bills and bonds, the sixes, which are futures contracts on currencies, and let's see, we've got Bitcoin futures. Here's cocoa futures for those that are trading in agriculture futures. There are futures on crude oil, which many of us trade in. The micros and the minis are going to be on here as well. Here are some specific ones, the DAX futures for European currency traders. I'm just grabbing a few out of that pop up here. We've got natural gas, the S&P, palm oil futures. Here are the micro futures on the currencies. We've got all of the different futures markets represented here. You can trade in any one of these by clicking and choosing the correct month. Now, there are several different participants or players in the futures market. There are speculators like us, the retail traders. Then there are the hedgers and the arbitrageurs. And to a lesser extent, there are the different intermediaries like brokers and market makers that help to facilitate the trading in the different futures exchanges. But most of the key participants are the speculators and the hedgers. Now, what are speculators like retail traders? We simply take a long or a short position based on our analysis of an upcoming move on the market, whether it's in the short term based on a strategy on one of our charts, or a slightly longer term based on the market in general, geopolitics. Those longs or shorts are entered into with the expectation that they're going to be in the money and profitable before we close out that trade. Next, the hedgers. Hedgers are businesses that deal in that asset or that instrument, like, for example, oil or coffee or even financial instruments. And those businesses want to hedge or guarantee the future price changes. So they use future contracts to ensure that they're going to be able to access a satisfactory price if any changes in the market occur. For example, if I'm an oil producer, I might use a futures contract to lock in a price in the future when I know I'm going to be producing that oil and at the time that that future contract expires. So in simple terms, hedging is basically used to reduce current business risk in that same underlying instrument. Now, a little more sophisticated are the arbitrageurs. Arbitrage is a very sophisticated investing strategy that captures small, micro price movement in differences actually in that instrument in two different markets. So an arbitrager might sell an overpriced futures contract in one market and buy an underpriced contract in a different market. For example, here and one of the futures markets in Europe or Asia or any place else around the world. As a good example, if any of you followed the SBF, the Sam Bankman-Fried FTX debacle, that's exactly how he started. He leveraged the difference in the spreads of Bitcoin in different global markets. That part was completely legal. That's how he made a ton of money in the beginning. Unfortunately, that wasn't enough for him. He went on to massively defraud his investors and clients, and you all know what happened. Now, just a few other important points to know about with futures contracts. Remember, because they are used to conduct business by hedgers, they expire on a predetermined date. Mostly that date is going to be the third Friday of the month, and sometimes the third Friday of every quarter, depending on the instrument. So you should be paying attention to switching over. That's called rolling over your instrument date so that you are on the correct month. You don't want to be on the wrong month. There's not going to be enough volume to trade in. Very poor liquidity. So just to recap, there are three major players in the futures contract market. Speculators, like retail traders like us, the hedgers, and the arbitragers. Speculators take longs or shorts based on their expectation of a move so that they can profit on the trade. Hedgers protect their business, or banks, financial institutions, and individuals protect their investment portfolios. They take their positions for slightly longer terms. And the arbitragers, they earn risk-free profit by leveraging, in a very sophisticated trading, very high-speed trading, the difference between the spreads in different markets. So that's it, traders. Those are the key market participants in the futures market. Good trading, and we'll see you the next time.